Construction Partners Incorporated. NASDAQ, ROAD. Quantitative Deep Research Analysis Report. Construction Quality Control Operational Risk Assessment Multi-Scenario Investment Thesis. Report date. Sector. Exchange. Rating bias. April 2026. Civil infrastructure/construction. NASDAQ. Constructive/monitor.
Workout paused.
Executive summary. Construction Partners Incorporated, ROAD, is a vertically integrated civil infrastructure contractor operating across 8 high-growth Sunbelt states. This deep research report provides a comprehensive quantitative assessment of the company's construction quality control (QC) practices, regulatory compliance history, operational risk profile, and multi-scenario investment thesis as of April 2026. The analysis draws exclusively from SEC filings, 10-K per 10-Q through FY 2025, earnings releases, regulatory databases, and third-party research. Key findings at a glance. Metric. Finding. Signal. QC violations. Zero material OSHA/MSHA citations, code violations, or defect-related lawsuits in all reviewed filings through FY 2025. Positive. Revenue growth. FY 2025 revenue $2.812 billion, plus 54% YOY. FY 2026 guidance $3.48-3.56 plus 24 to 26% YOY. Positive. Backlog. Record $3.09 billion at December 31, 2025, 18 consecutive quarters of growth, 80-90% FY 2026 revenue coverage. Positive. EBITDA margin. FY 2025 ADJ EBITDA margin 15.1%, plus 296 BPS YOY, Q1 FY 2026 13.9%, plus 63% YOY absolute. Positive. Short seller risk. Spruce Point, January 2025, raised transparency/accounting concerns, ROAD disputed all claims, no QC-related allegations. Monitor. Acquisition pace. 8 acquisitions in less than 15 months through early 2026, integration execution is the primary operational risk. Monitor. Investment thesis. Base plus bull combined probability 70%, constructive long-term but warrant near-term execution scrutiny. Constructive. 2. Company overview and business model. 2.1 Corporate profile. Construction Partners Incorporated, NASDAQ, ROAD, is an asphalt-centric civil infrastructure contractor headquartered in Dothan, Alabama. The company specializes in roadway construction, highway resurfacing, site development, and aggregate production. Its operational footprint spans 8 Sunbelt states: Alabama, Florida, Georgia, North Carolina, Oklahoma, South Carolina, Tennessee, and Texas. Markets characterized by above-average population growth, accelerating state transportation budgets, and substantial federal IIJA, Infrastructure Investment and Jobs Act, allocations. ROAD's workforce of approximately 6,800 employees operates across a geographically distributed network of hot mix asphalt, HMA, plants, aggregate quarries, and liquid asphalt terminals. The company executes a disciplined build-and-acquire strategy, growing organically within existing markets while pursuing acquisitive expansion into adjacent high-growth geographies. 2.2 Revenue composition and customer concentration. Revenue is predominantly driven by public sector contracts, with state departments of transportation, DOTs, representing approximately 43% of FY 2025 revenues. No single DOT customer exceeded 10% of total revenues, providing meaningful diversification across government funding streams. This public sector emphasis is a deliberate risk management strategy. Government infrastructure contracts tend to be non-cyclical, long duration, and subject to rigorous independent inspection protocols. Revenue category. Approximate % of FY 2025 revenue. Risk profile. State DOTs, highway maintenance/resurfacing. 43%. Low government-funded, independent QC oversight. Other public sector, airports, municipalities. 35%. Low medium, steady budgets, competitive bidding. Private sector, commercial site development. 22%. Medium, cyclical exposure, higher margin variance. 2.3 Vertical integration as structural differentiation. ROAD's defining competitive characteristic is its deep vertical integration across the infrastructure value chain. By owning and operating aggregate quarries, raw material extraction, HMA production plants, materials processing, liquid asphalt terminals, supply chain control, and paving/placement crews, field execution, the company controls quality, cost, and scheduling at each production stage. This contrasts sharply with non-integrated peers who rely on third-party suppliers and subcontractors, introducing variability risk at every handoff. The practical consequences are measurable. Internal benchmarking data cited in company materials indicates that vertical integration enables ROAD to achieve tighter adherence to asphalt mix design specifications, e.g., gradation, binder content, air voids, than market-dependent peers. The ownership of HMA plants also allows rapid mix design adjustments in response to weather conditions, a critical variable in road paving quality, without the negotiation lag inherent in third-party supply arrangements. 2.4 Geographic footprint and market dynamics. ROAD's 8-state Sunbelt focus is not incidental, it reflects a deliberate concentration in markets with structurally favorable infrastructure demand drivers. The Sunbelt states collectively account for the majority of U.S. population growth, placing sustained pressure on road capacity and maintenance needs. State DOT budgets across these markets have seen above-average increases, amplified by IIJ allocations that are projected to deploy at accelerating rates through FY 2026 to FY 2030. Texas and Georgia represent the 2 most recently expanded platforms, both via acquisition in the 15-month window through early 2026. Texas in particular represents a multi-decade expansion opportunity. The Texas DOT, TxDOT, operates one of the largest state transportation budgets in the United States, and ROAD's entry into this market through acquisition of an established regional operator provides immediate access to pre-qualified contractor relationships. 3. Quantitative financial performance analysis. 3.1 Revenue trajectory and growth decomposition. ROAD has achieved one of the most aggressive revenue growth trajectories among publicly traded mid-cap infrastructure contractors. The FY 2025 revenue figure of $2.812 billion represents a 54.2% increase over the FY 2024 base of $1.824 billion, a pace that significantly outpaces both organic industry growth rates and comparable peer expansion. This growth is attributable to a combination of M&A activity, primary driver, and organic demand tailwinds, secondary driver. Period. Revenue, $M. YOY growth. ADJ EBITDA, $M. ADJ EBITDA margin. FY 2024, full year. $1,824. $220. 12.1%. FY 2025, full year. $2,812. Plus 54.2%. $425. 15.1%, plus 296 BPS. Q1 FY 2026. $809.50. Plus 44.1% YOY. $112.20. 13.9%, plus 63% ABS. YOY. FY 2026 guidance, raised February 2026. $3,480 to $3,560. Plus 24 to 26%. Implied $525 of $540. 15.0 of 15.2%. The Q1 FY 2026 margin of 13.9% reflects typical seasonality. Q1 is historically the weakest quarter due to weather constraints on paving activity in northern portions of ROAD's footprint. The full-year trajectory toward 15% plus is consistent with prior year seasonal patterns and management guidance. 3.2 Backlog analysis, the core revenue visibility engine. ROAD's backlog has become one of the most frequently cited metrics by both sell-side analysts and institutional investors as evidence of revenue predictability. The record $3.09 billion backlog as of December 31, 2025, plus 57% YOY, represents approximately 80 to 90% of the midpoint of FY 2026 guidance, providing a degree of revenue certainty unusual for a construction company of ROAD's scale and growth rate. Reporting date. Backlog, $B. YOY change. Consecutive QTRS growth. September 30, 2024. $1.96 billion. 15. December 31, 2025, record. $3.09 billion. Plus 57.7%. 18, record. FY 2026 revenue coverage from backlog. $2.8 to 3.0 B. 80 to 90%. Exceptional visibility. The 18 consecutive quarter streak of backlog growth is a quantitatively significant signal. In the civil construction industry, sustained backlog growth at this duration typically reflects 1. Consistent bid award ratios above replacement rates, 2. Organic demand growth outpacing revenue recognition velocity, and 3. Successful integration of acquired businesses' existing contract portfolios. The short seller's January 2025 critique questioned the quality of backlog, specifically regarding certain Texas contracts, but ROAD's subsequent management commentary and continued backlog expansion through Q1 FY 2026 provide partial validation of backlog integrity. 3.3 Net income, guidance, and profitability drivers. FY 2026 net income guidance of $154 to $158 million reflects continued margin expansion from scale efficiencies, improved procurement leverage on raw material inputs, and the absorption of acquisition-related costs. At the guidance midpoint, this implies a net margin of approximately 4.4% on $3.52 billion in revenue, a figure that, while seemingly modest, is consistent with or superior to comparably scaled civil infrastructure contractors operating primarily on public sector fixed-price contracts. Key profitability drivers include 1. HMA plant utilization rates. Higher throughput reduces per unit fixed cost absorption. 2. Liquid asphalt price management. ROAD's terminal ownership provides a partial natural hedge against spot asphalt price volatility. 3. Equipment fleet efficiency. The company's own fleet versus rented model reduces per job equipment costs as utilization scales. And 4. Organic versus acquired revenue mix. Organic revenue typically carries higher margins than newly acquired platforms still being integrated under ROAD's cost structure. 4. Construction quality control practices, standards, and performance record. 4.1 Regulatory framework governing road construction QC. Public road construction contracts in the United States operate within one of the most prescriptive quality assurance frameworks of any construction sector. Federal Highway Administration, FHWA, regulations under 23 CFR Part 637 mandate a three-tiered quality management structure for all federally funded projects. Contractor quality control, CQC. The paving contractor must maintain its own internal QC plan, including sampling, testing, and documentation at defined intervals for materials, asphalt mix gradation, binder content, in-place density, smoothness/IRI measurements. Agency verification. The contracting state DOT conducts independent testing to verify contractor QC results, using split samples and independent test methods. Independent assurance, IA. An additional layer of oversight, typically a third-party laboratory or separate DOT division, validates that both the contractors and agencies' testing programs meet AASHTO and FHWA standards. This tripartite oversight structure means that any material deficiency in roads paving quality would be detected not just internally, but via two independent external verification layers before project acceptance. Acceptance pay adjustments, positive or negative incentives/disincentives, tied to smoothness, density, and mixed design compliance further align financial incentives with QC performance. 4.2 Roads QC infrastructure vertical integration as quality moat. Roads vertical integration creates several structural QC advantages that are genuinely difficult to replicate without substantial capital investment. Aggregate quality control. In-house quarry operations allow Road to specify and verify aggregate gradation, hardness, Los Angeles abrasion values, and soundness at the source. Third-party aggregate suppliers may deliver materials that technically meet specification minimums but vary in performance characteristics, variability that Road's owned quarries can minimize through consistent mining and processing protocols. HMA mix design and production consistency. Road's owned HMA plant network enables real-time mix design verification and adjustment. Plant operators can modify asphalt content, aggregate gradation, and mixing temperature within specified tolerances in response to ambient conditions or test results, a feedback loop that is faster and more responsive than the supply chain of a non-integrated competitor dependent on third-party material delivery. Liquid asphalt terminal ownership. Ownership of liquid asphalt, performance-grade binder, terminal capacity provides Road with direct control over binder inventory, temperature management, and quality testing prior to plant introduction. Binder degradation from improper storage temperature is a known asphalt QC risk. Terminal ownership eliminates a key source of this variability. 4.3 Regulatory compliance record, documented findings. An extensive review of all available public records, including Road's SEC filings, 10K for FY 2021 through FY 2025, 10Q filings through Q1 FY 2026, OSHA enforcement database records, MSHA inspection records, state DOT contractor performance databases, where publicly available, and litigation databases, reveals the following. Compliance category. Documented findings. Risk assessment. OSHA violations/citations. None material, not referenced in any SEC filing. Low. MSHA violations, mining operations. No citations referenced, standard compliance noted. Low. DOT inspector citations/defective work. None identified in public records or filings. Low. Building code violations. None, not applicable to core road paving scope. Not applicable. Material quality defects/rework claims. No material claims identified, routine warranty reserve standard. Low. Government debarment or suspension. None, generic risk flagged in filings as standard disclosure. Low. Litigation, quality/defective work. Only routine contract disputes, change orders, employment, workers' comp, none material or QC related. Low. The absence of material QC violations, OSHA citations, or defect-related litigation over the reviewed period is a quantitatively meaningful signal. In the broader construction industry, OSHA data indicates that large contractors, 500-plus employees, typically experience 5 to 10% annual incidence rates for recordable safety events and a smaller but non-trivial rate of citation-level compliance findings. Road's clean record, if maintained through a period of rapid workforce expansion via acquisition, would represent genuine operational outperformance relative to industry norms. Veach short seller analysis and transparency risk assessment. 5.1 Spruce Point Capital Management Report, January 2025. On January 15, 2025, Spruce Point Capital Management, a short seller known for detailed forensic accounting analyses, published a bearish research report on Road. The report triggered a material single-session stock decline and subsequently prompted the filing of multiple securities fraud class action lawsuits by plaintiff law firms. The full scope of Spruce Point's claims, Road's responses, and the analytical implications are detailed below. Core allegations, Spruce Point. Organic growth overstatement. Spruce Point alleged that Road's reported organic growth understated the degree to which reported growth was acquisition-driven, implying that the underlying business is growing slower than presented. Backlog quality concerns. The report questioned whether certain contracts included in the backlog, particularly in Texas, had been properly awarded or were subject to conditions that would preclude conversion to revenue. Aggressive accounting. Concerns were raised about revenue recognition practices on certain change order heavy contracts, with potential for delayed recognition of cost overruns. Transparency gaps. The report highlighted comparatively limited disclosure of per-market organic growth statistics relative to peers, making independent verification of organic growth claims difficult. Road management response. Road issued a detailed written rebuttal characterizing Spruce Point's claims as containing false statements and specifically disputed the data underlying the Texas contract backlog allegations. Management pointed to independent third-party verification of backlog data and noted that the 18 consecutive quarter backlog growth streak, continuing through the report date, was inconsistent with the narrative of manufactured backlog. Analytical assessment, QC versus financial transparency. A critical distinction for quality-focused risk assessment, Spruce Point's allegations are exclusively financial and disclosure-related in nature. The report contains no allegations of physical construction defects, DOT inspector citations, defective asphalt work, or safety violations. This is analytically important. It means that even if all financial transparency concerns were confirmed, they would not independently indicate QC infrastructure failure. The securities fraud investigations opened by plaintiff law firms following the Spruce Point report introduce ongoing litigation risk that warrants monitoring but does not, absent new facts, constitute a high probability material liability. Class action filings of this nature are a near automatic plaintiff firm response to large cap short seller reports, and a majority do not result in material settlements. 1 comprehensive risk register. Risk factor. Description. Likelihood. Impact. Net risk. M&A integration execution. 8 acquisitions in less than 15 months. QC standards, safety culture, and cost controls must be harmonized across new platforms. Medium. High. Elevated. Asphalt input cost inflation. Liquid asphalt price is crude oil correlated. Sustained $20 plus per BBL move could compress margins 100 to 200 BPS. Medium. Medium. Moderate. Federal funding continuity. IIJA funding extension subject to congressional reauthorization. Adverse policy change could reduce DOT project award pipeline. Low. High. Moderate. Skilled labor availability. HMA plant operators and experienced paving crew foremen are in constrained supply and growth markets. Wage inflation and turnover risk. Medium. Medium. Moderate. Weather and seasonality. Paving requires minimum temperature thresholds. Extended cold/wet periods compress Q1/Q4 revenues and can challenge annual guidance. Medium. Low MED. Low. QC failure/inspector citations. Rapid scaling plus integration pressure could introduce QC variance. Currently 0 material incidents but tail risk during aggressive growth. Low. High. Moderate. Short seller/securities litigation. Spruce Point triggered class action investigations ongoing. Settlement risk if organic growth disclosure gaps confirmed. Low MED. Medium. Low mod. Government debarment. Federal state contracting rules permit suspension for serious violations. Generic risk with no current basis for concern. Very low. Severe. Low. 7. Multi-scenario investment thesis. The following scenarios represent probability-weighted assessments derived from backlog visibility, margin trends, acquisition integration history, regulatory compliance record, and disclosed risk factors. Probabilities are subjective analyst estimates and should not be construed as guarantees of future outcomes. Scenario. Probability. Key drivers. Extreme bull. 2.5%. Multi-year IIJA extensions, hyper M&A, QC excellence, new state expansion, margins 16 to 18%. Bull. 25%. Seamless integration, market share gains, 20% plus revenue CAGR to FY 2030, margin to mid 15% plus. Base. 45%. Guided growth execution, stable 15% margins, mid-teens earnings CAGR, inline peer multiple. Bear. 27.5%. Integration friction, margin compression 100 to 200 BPS, organic growth miss, multiple compression. Extreme bear. 2.5%. Systemic QC failure, DOT contract terminations, debarment risk, equity downside 35-50% plus. 7.1 bull case, 25% probability. The bull case rests on the premise that ROAD's vertical integration model compounds value more efficiently at scale than the market currently prices in. As the company's HMA plant network, quarry capacity, and liquid asphalt terminal footprint expand through acquisition, fixed cost leverage accelerates. New platforms, Texas, Georgia, are integrated under ROAD's shared standards framework, delivering cost convergence toward the system average within 18 to 24 months of acquisition. In this scenario, ROAD achieves 20% plus revenue CAGR through FY 2030, reaching $5 billion plus in revenues, with EBITDA margins expanding to the mid to high 15% range as integration costs normalize. The Sunbelt demographic tailwind continues to drive DOT budget growth above the national average. No QC incidents materialize. The clean compliance record helps ROAD win premium contract positions, e.g., design build awards, multi-year maintenance contracts. The stock re-rates from its current infrastructure peer PE toward a mid-20s growth multiple, generating substantial equity upside. Revenue path, $4.2b, FY 2027E, $5.0b, FY 2029E. EBITDA margin, 15.5 to 16.5% by FY 2028. Key upside catalysts, TxDOT increased appropriations, IIJA Tranche 2 deployment acceleration, greenfield HMA plants in underserved markets. 7.2 base case, 45% probability. The base case reflects continuation of ROAD's demonstrable execution track record at a modestly reduced growth rate, consistent with management's own FY 2026 guidance. Revenue grows 24 to 26% in FY 2026, driven primarily by backlog conversion, high visibility, and a 7 to 8% organic contribution. Acquired platforms, Texas, Georgia, deliver partial integration synergies in FY 2026, with fuller margin contribution in FY 2027. EBITDA margins stabilize in the 14.8 to 15.3% range. In this scenario, the Spruce Point concerns remain unresolved but do not escalate to material litigation outcomes. QC standards hold across the expanded network with minor friction, occasional change order disputes, no DOT citations. Stock trades at 30 to 40x forward PE, consistent with the upper tier of infrastructure contractor peers given ROAD's superior margin profile and backlog visibility. Revenue path, $3.52 billion, FY 2026E, midpoint guidance, $4.0 billion plus, FY 2027E. EBITDA margin, 14.9 to 15.2% FY 2026. Net income, $154-158M, FY 2026 guidance midpoint. Key base assumptions: federal funding stability, asphalt input costs plus 5 to 8% YOY, manageable, Texas/Georgia integration on track. 7.3 bear case, 27.5% probability, emphasized. The bear case warrants emphasis not because current evidence supports it, but because the risks it identifies are structurally embedded in ROAD's aggressive acquisition strategy and are difficult to observe in advance. 8 acquisitions in under 15 months is an integration cadence that would challenge even the best capitalized and most experienced acquirers. Each acquired company brings its own QC culture, equipment maintenance standards, workforce practices, and contract reporting systems, all of which must be harmonized under ROAD's framework without disrupting ongoing project execution. The financial manifestation of integration friction typically appears with a 2 to 4 quarter lag, elevated rework costs, underperforming project margins, unexpected change order disputes with DOTs, and slower than expected revenue recognition on acquired backlog. These dynamics, if they materialize, would produce organic growth below the 7 to 8% guidance, margin compression of 100 to 200 basis points, and downward revision of FY 2026 earnings guidance, a combination historically associated with 20 to 35% equity multiple compression in construction sector peers. Revenue miss scenario: $3.2-3.3b versus $3.48-3.56b guidance, if Texas/Georgia integration lags. EBITDA margin compression: 13.5 to 14.0% in bear scenario. Short seller risk amplification: any organic miss would likely renew Spruce Point narrative, increasing multiple compression. QC friction indicator: watch for DOT dispute disclosures in 10Q filings, change order disputes escalating above historical norms. 7.4 extreme bear case, 2.5% probability. The extreme bear scenario requires a confluence of negative events that are individually low probability but collectively would be devastating. The triggering event would be a material QC failure on one or more high-profile DOT projects, for example, widespread asphalt delamination, compaction deficiencies identified through cores, or smoothness, IRI, failures on a state-interstate resurfacing contract. This would trigger DOT acceptance pay disincentives, potential contract dispute claims, and public attention. If accompanied by evidence of systemic rather than isolated failure, e.g., across multiple states, the consequences could escalate to formal DOT performance review, state-level suspension from bidding, and in severe cases, federal contractor debarment proceedings. These outcomes would directly impair ROAD's backlog conversion capability, the primary valuation support mechanism. Combined with securities litigation from the Spruce Point triggered class actions, the equity downside in this scenario would be 35 of 50% plus. This probability is assessed at only 2.5% given 1. The absence of any historical QC incidents, 2. The structural protection provided by public contract inspection frameworks, 3. Vertical integration's documented role in reducing mixed design variability, and 4. Management's explicit emphasis on quality culture across acquired businesses. The scenario would require a systemic and simultaneous breakdown of QC practices across multiple acquired platforms, an event that would contradict the entire operational thesis underlying ROAD's business model. 7.5 extreme bull case, 2.5% probability. The extreme bull scenario envisions ROAD as a platform company achieving national infrastructure scale. Multi-year congressional extensions of IIJA, combined with state-level bond issuances for transportation, historically popular ballot measures in Sunbelt states, create a demand environment that exceeds even the most optimistic current projections. ROAD accelerates its M&A pace, successfully entering additional high-growth markets, e.g., Arizona, Nevada, Virginia, while maintaining QC standards. At $5 billion plus in revenue with 16 to 18% EBITDA margins, ROAD's FCF generation would support meaningful return of capital programs, dividends, buybacks, while funding continued organic investment. The stock would be eligible for re-rating toward growth compounder valuation multiples, with significant institutional re-weighting as ROAD enters major index eligibility thresholds. This scenario is assigned only 2.5% probability given execution complexity and the historical rarity of sustained hypergrowth in the infrastructure contracting sector. 8. Valuation framework and sensitivity analysis. 8.1 Relative valuation, peer comparison. ROAD trades at a premium to the median of its civil infrastructure contractor peer group, justified in our view by its superior EBITDA margin profile, backlog visibility, and the scarcity value of a vertically integrated Sunbelt-focused platform at this scale. The following table provides a comparative framework. Metric. ROAD, FI 2026E. Peer median. Premium/discount. Justification. EV/EBITDA, forward. 18-22x. 13-15x. Plus 30 to 45%. Margin premium plus backlog visibility. PE, forward NTM. 30 of 40x. 20-25x. Plus 40 to 60%. Growth rate differential versus peers. Revenue growth, YOY. Plus 24 to 26%. Plus 5 to 8%. Plus 18 PPTS. Acquisitive plus organic Sunbelt growth. EBITDA margin. 15%. 10-12%. Plus 300 to 500 BPS. Vertical integration cost advantage. Backlog coverage, FY revenue. 80 to 90%. 40 to 60%. Plus 30 PPTS. Revenue visibility premium. 8.2 Key sensitivities. The following table quantifies the estimated revenue and EBITDA impact of key variable changes relative to our base case assumptions. Variable. Downside sensitivity. Upside sensitivity. Federal state funding level. Minus 10% DOT spending equals minus $350 million revenue, minus 50 BPS margin. Plus 10% DOT spending equals plus $350 M revenue. Asphalt input cost, $/ton. Plus $20/ton sustained equals minus 150 to minus 200 BPS EBITDA margin. Minus $15 per ton equals plus 100 to plus 150 BPS EBITDA margin. Organic growth rate. 3 to 4% versus 7 to 8% guide equals minus $125 million revenue, minus 35 BPS margin. 10 to 12% equals plus $100 M revenue incremental upside. Integration success, acquired margins. Acquired platforms at 11% versus 15% system equals minus 100 BPS blended margin. Faster convergence equals plus 50 BPS margin 12 months early. QC incidents/DOT disputes. Material citation/dispute equals 10 to 20% multiple compression, legal costs. Clean record maintained equals supports premium multiple. 9. Monitoring framework, key indicators and catalysts. 9.1 Near-term catalysts to monitor. The following events and disclosures are identified as high-significance monitoring triggers for investors in ROAD over the next 12 months. Timing. Catalyst/event. Bull signal. Bear signal. Q2 FY 2026 earnings. Backlog update, organic growth disclosure, Texas/Georgia contribution, any change order dispute disclosure. Backlog greater than $3.2 billion, Texas margin in line with system, no new disputes. Backlog flat, margin miss, dispute disclosures. FY 2026 10K, December 2026. Litigation section updates, OSHA/MSHA disclosure, warranty reserve movements. No new litigation, stable warranty reserves. New QC-related claims, elevated reserves. IIJA appropriations. Congressional action on FY 2027 transportation funding, Sunbelt state DOT budget cycles. Increased allocations, new state bond issuances. Funding rescissions or deferrals. Additional M&A. Any announced acquisition, market will scrutinize integration capacity given recent pace. Disciplined pause, integration of existing platforms demonstrably on track. Further acquisitions before prior integration demonstrated. Securities litigation updates. Progress in Spruce Point related class action investigations and any court filings. Cases dismissed or settled nominally. Case certification, material settlement range established. X industry context and competitive positioning. 10.1 Sunbelt infrastructure demand drivers. The macroeconomic context underpinning ROAD's growth narrative deserves quantitative examination. The 8 states in ROAD's footprint, Alabama, Florida, Georgia, North Carolina, Oklahoma, South Carolina, Tennessee, and Texas, collectively accounted for approximately 32% of U.S. population growth from 2020 to 2025, despite representing only 22% of total U.S. population. This disproportionate growth creates structural and compounding infrastructure demand that is relatively independent of national economic cycles. Texas alone has experienced sustained net in-migration exceeding 200,000 persons annually in recent years. Each incremental 100,000 residents in a typical Sunbelt growth market generates an estimated $15 to $25 million in annual incremental road maintenance and capacity expenditure needs, based on state DOT per lane mile maintenance cost data. At Texas's growth rate, this represents $300 to $500 million in incremental annual state spending on road infrastructure, a significant tailwind for a company that has just established a major Texas platform. 10.2 IIJA funding landscape. The Infrastructure Investment and Jobs Act, IIJA, signed into law in November 2021, authorized $1.2 trillion in total infrastructure spending over 5 years, with approximately $110 billion specifically allocated to roads and bridges. Deployment of IIJA funds follows a ramp profile. Early years saw slower obligation rates as states developed project pipelines, while FY 2024 to FY 2026 represent the highest deployment velocity period. Roads backlog acceleration from $1.96 billion to $3.09 billion between September 2024 and December 2025 is partially attributable to IIJA-driven project award acceleration in its core markets. 10.3 Vertical integration competitive dynamics. The competitive landscape for civil infrastructure contractors is bifurcated between vertically integrated platforms, like ROAD, and non-integrated specialty paving contractors. Non-integrated contractors face margin compression risk when aggregate prices rise. They are price takers on their largest input cost. During periods of asphalt price inflation, which tracks crude oil with a 30 to 60-day lag, non-integrated paving contractors typically see gross margins compress 200 to 400 basis points, while vertically integrated operators are partially insulated. This creates a counter-cyclical competitive advantage for ROAD. During periods of input cost inflation that stress non-integrated competitors, ROAD's vertical integration allows it to maintain bid competitiveness while sustaining margins that smaller competitors cannot match. This dynamic has likely contributed to ROAD's market share gains in its existing markets and creates a structural headwind for new market entrants attempting to compete directly. 11. Conclusions and investment recommendations. 11.1 Summary findings. This quantitative deep research analysis of Construction Partners Incorporated, ROAD, yields the following primary conclusions. Quality control record. ROAD's documented absence of material OSHA citations, DOT inspector violations, defective work claims, or code-related litigation is a material positive differentiator. For a company of 6,800 employees operating high-hazard construction activities across 8 states, this record requires active operational excellence to maintain. It is not a passive default condition. Financial performance. FY 2025 revenue of $2.812 billion, plus 54% YOY, record $3.09 billion backlog, and 15.1% EBITDA margins collectively represent one of the strongest multi-metric performances in the civil infrastructure contractor universe for the period. The 18 consecutive quarter backlog growth streak is quantitatively unusual and provides exceptional FY 2026 revenue visibility. Primary risk. The most significant near-term risk is M&A integration execution quality, not construction quality per S8 acquisitions in under 15 months is an aggressive pace that introduces operational complexity risk across QC standards, cost controls, financial reporting, and safety culture. This risk is elevated, bear case 27.5% probability, but not dominant. Short seller concerns. The Spruce Point allegations are financial/disclosure in nature, not operational. They merit monitoring but do not independently constitute evidence of construction quality failure. The ongoing securities litigation is a tail risk, not a near-term earnings threat. Investment stance. The probability-weighted scenario analysis yields a constructive investment thesis. Base plus bull cases account for approximately 70% of probability mass. The risk-reward is positive for long-term investors with a 3 to 5 year horizon and tolerance for near-term integration execution uncertainty. 11.2 Key monitoring priorities. Based on this analysis, the following are the highest priority monitoring items for investors. Q2 FY 2026 and Q3 FY 2026 backlog conversion quality, specifically organic revenue growth versus acquisition contribution, and gross margin trends by acquired platform. Any disclosure of DOT disputes, change order escalations, or warranty reserve increases in quarterly filings, these would be the earliest detectable indicators of QC integration friction. Texas and Georgia platform margin trajectory, convergence towards system margins within 18 to 24 months would be strong validation of the integration thesis. IIJA funding continuity at the federal level, any rescission or significant deferral of road/bridge allocations would introduce meaningful near-term project pipeline risk. Additional acquisition announcements. Given the current integration burden, further acquisitions before demonstrable progress on Texas/Georgia would be a negative signal for the investment thesis. 11.3 Final assessment. Investment dimension. Assessment. Construction quality/regulatory risk. Low clean record, strong QC infrastructure, public contract oversight provides independent verification. Revenue visibility/backlog quality. High 80 to 90% FY 2026 coverage, 18-quarter growth streak, disputed but continuing. Margin sustainability. Medium-high structural advantages intact, integration timing introduces near-term uncertainty. M&A integration execution risk. Elevated primary risk factor, deserves highest monitoring priority. Short seller/litigation risk. Moderate monitoring warranted, not yet a fundamental threat. Long-term investment thesis. Constructive, base plus bull 70% probability, Sunbelt structural tailwinds support multi-year value creation. 12. Disclaimers and disclosures. This research report has been prepared for informational purposes only and does not constitute investment advice, a solicitation, or a recommendation to buy or sell any security. The analysis, probability assessments, and conclusions contained herein are the product of quantitative analytical frameworks applied to publicly available information and represent opinions subject to change without notice. All financial data referenced in this report is sourced from Construction Partners Incorporated SEC filings, Form 10-K, Form 10-Q, earnings press releases, investor presentations, and third-party research reports, all through April 2026. No non-public information has been used in preparation of this report. Regulatory compliance data is sourced from publicly accessible federal databases, OSHA, MSHA, state agency records, and road zone disclosures. The absence of identified violations reflects available public record but does not constitute a guarantee that no unreported violations exist. Probability estimates for investment scenarios are subjective analyst judgments based on historical base rates, sector benchmarks, and road-specific factors. They are not actuarial calculations and should not be relied upon as predictive of future outcomes. All investing involves risk, including possible loss of principal. Past operational performance, including the absence of quality control violations, does not guarantee future outcomes. This document is intended for use by sophisticated investors capable of evaluating the information independently. Recipients should conduct their own due diligence, including consultation with licensed financial, legal, and tax advisors, before making any investment decision. The author of this report holds no positions in ROAD securities as of the report date. Construction Partners Incorporated, NASDAQ, ROAD, Deep Research Analysis, April 2026, prepared for informational purposes only.